In this video, we will take a look at the common financial business terms all local small business owners should know. There are so many terms, but which ones matter most? Local small business owners come from all walks of life, and it isn't uncommon for most new small local business owners to not be familiar with many of the key business terms they will be coming across or asked about. Nor will many of them know that they should be keeping track of some of these items. If you are one of them, don't worry, you're not alone. We are here to help. While there are many business terms out there, we will focus on the core ones that all local business owners should know and why. Each of your businesses are unique, but these terms will pretty much cross all business types in some degree or another. Typically, we could call all of these specific business terms finance terms. For our purposes, we will break them down into 4 key groups to help make the link between the terms easier to understand how they impact or reflect on your local small business. The first group will be terms specific to charging customers or clients. The next group will be specific to tracking expenses. The third group, tracking sales and expenses together. And finally, we'll discuss the terms that are basically your business's report card. Now let's take a closer look at the ones you should know. First up will be the terms specific to charging customers or clients. These will be terms that specifically refer to money you collect from your customers or clients at the time of service. Sales and revenue, the exchange of goods or services for money. When the term revenue is used, it typically will include any credits or discounts for returned merchandise. Accounts receivable refers to money owed by customers to your company as payment for goods or services. Think of it as an IOU. Side note, accounts receivables are considered an asset on the company's balance sheet since it assumes a client is legally obligated to pay this amount. A general ledger. This is the complete recording of a company's financial transactions over the lifetime of the organization. This can be either an Excel sheet or an accounting service. Many small business owners use QuickBooks or an online service like FreshBooks. The advantages to QuickBooks and FreshBooks is the ability to also create invoices. Now let's take a look at terms specific to tracking your expenses. Each business has expenses. However, not all expenses are equal. They each have a different category that they technically fall under. Here we will explore the terms commonly associated with your expenses. Accruals. These are expenses that have been incurred but are not yet paid. They also could be sales that have been completed but not yet billed. Accruals also relate to items that will hit your books soon, positive or negative, but haven't yet, due to the time it takes to complete the accounting process on them. Cost of goods sold, also known as COGS, the raw materials and labor costs associated with creating a product to sell, the cost of finished goods for resale, or the cost of delivering a service. Now let's take a better look at this to make it make sense. If you take all the bicycle parts, that would be part of your cost of goods sold, plus the labor it takes to assemble the bike, and eventually you get the bike. So the cost of goods sold would be the parts and the labor. Depreciation. Depreciation is the decrease of an item's value over time due to the use for tax purposes, usually used with larger pieces of equipment or high-ticket items. These are items that can be written off on tax returns based on their depreciation to help with profitability. Usually these are items that are used for more than a year. However, see an accountant for what you can depreciate annually. Expenses are the overhead to run your business, such as rent, marketing, utilities, accounting, legal, payroll, admin support, taxes, and interest. Fixed expenses. Fixed expenses stay pretty consistent from month to month. This typically includes expenses like manager salaries, rent, utilities, and insurance. Now, fixed expenses are more common with brick and mortar type businesses. These costs are usually not affected by the fluctuation in sales, production, or the market. Variable expenses. Variable expenses can go up or down based on the increase and decrease to the company's sales and production. For example, if you have to hire more people due to seasonal business, your employee payroll will swing up or down. This will also increase training costs, hiring costs, etc. Accrued expenses are accounting expenses that are being reported but have not yet been paid. A lot of times, these are expenses that might have terms of net 30, 60, or 90. Typically, once again, when you purchase products, but you don't have to pay for them right away. Operational expenses are costs that are necessary for a company to conduct business, to keep it operational. Operational expenses can be both fixed or variable. So, for example, salaries, cost of sales, insurance, rentals, utilities, repairs and maintenance, stuff like that. Liabilities. Liabilities are debts that a company is responsible to pay in both the short and long term. Liabilities are the debts of the business, such as accounts payable or money owed, such as invoices to vendors, your lease, bank loans, or payroll. Our next category is going to be terms that refer to tracking of sales and expenses together. In a nutshell, your business is based off of what you take in versus what you spend. However, there are other factors like inventory and other carrying costs. So in this section, we will cover the terms associated with looking at your business as a whole, from what comes in to what goes out and what just sits. There are two ways of doing your accounting. The accrual basis accounting method allows for some flexibility when expenses and income are recognized. In this method, companies report when the income is earned and when the expenses are incurred. Now hold on a second. Since this isn't as common with typical local small businesses, please make sure you consult with an accountant before using this method. Now the cash basis method is the one that most local small business owners use. Cash basis accounting is a straightforward accounting method where revenues and expenditures are recorded when payments are received and sent. Basically, as you go. Assets. Assets are everything that a company owns that has value. Typically, this is going to be your equipment, any property, land, cash, and tools. Large companies might also include intangible assets such as company stock, copyrights, patents, and trademarks. However, for most of you, it's going to be the items you use in your everyday business. Bad debt expenses. This is an entry on a company's income statement that tracks non-collectible accounts receivable. For example, bad debt. Basically, invoices that do not look like they're going to be paid and are being written off. Burn rate. How much money it costs you to run your business each month. You want to know your monthly burn rate so that you know how much money you need to keep in reserve, as it is best to have at least 6 months of operating capital at all time. Working capital. Commonly referred to as the amount of money a company has to invest or spend on necessary items in the business. Now, capital money is money that can be accessed, not including company assets or liabilities. So usually it's cash on hand. Physical year. A physical year is a period of time that a company uses for accounting purposes and preparing financial statements. For the vast majority of local small business owners, the fiscal year will match the calendar year. However, some larger companies might use October to help with closing out the books for the year and prepare all the financial statements for federal and state tax income. Gross margin. The gross margin is what you make prior to subtracting your expenses. So total revenue minus your cost of goods. So for example, let's say you have $4,500 in sales and $1,500 in cost of goods to make those. Your profits then are $3,000 or 66.6%. So the $3,000 divided by the $4,500. Profit margin. Your profit margin is what is left after you subtract not only the cost of goods, but also after you pay the expenses now. So the sales minus the product costs minus the expenses is what your profit is. So the profit margin is the percent difference. So for example, we'll go back to our last one. If the total sales are $4,000, cost of goods are $1,500, the expenses are $1,000, So $4,500 minus the $1,500 minus the $1,000 is now $2,000. So the actual profit is $2,000. Now to find the profit margin, you divide that profit by the sales. So you'll see it's 44.4%. Now let's take a look at the terms for your business report cards. These are the documents you should have to verify the health of your business. As a self-employed person, you might need these for purchasing a home or dealing with a bank. They are the snapshots of your business. Most successful business owners are always looking for these on a weekly, if not monthly basis to determine opportunities as well as successes. The three you definitely want to use on a regular basis are your sales plan forecasting tool, profit and loss statements, and your balance sheets. Your balance sheet is an overview of the company's financial status. This will include your assets, your liabilities, and the equity in the company. The balance sheet shows the business's financial position at a specific moment in time. Your break-even analysis, when your business's expenses match your sales revenue. The goal is to get your business quickly to a break-even point. It typically takes at least 12 to 18 months for a small business to break even. Your cash flow statement. This statement is a snapshot of the cash in the company and where it flows from one month to the other. Use this to evaluate your cash position in your business. Equity. Equity is the amount of money that has been invested in the company by its owners. This can also be referred to as owner's equity. Most local small business owners are sole proprietors or have maybe 2 or 3 other founders. Larger companies might also issue stock shares as part of their equity. However, the vast majority of local small business owners do not have this, so don't worry about it until you grow dramatically. Sales planning forecasting tool. A sales plan forecasting tool is critical to growing your business. It is the process of using historical data to predict the future business trends. It would include sales, inventory planning, costs, etc. You will want to keep ongoing records of what impacts your business daily, weekly, or monthly to use in the next year's forecasting. For example, if sales are down due to bad weather, then in the future you adjust your plan to offset this impact on the next goal. Profit and loss statement, also referred to as a P&L. A profit and loss statement is basically a report card of your business. The report is usually generated by the business owner or its accounting that lists earnings, expenses, net profits for a given period of time. Typically, you will do it month to month with a yearly rollout. It is basically where you break down every category of your business and what is being spent or taken in. Remember, knowledge is power. Put you and your business ahead of the others. Learning your business terms and how they impact your business is critical to taking your sales and profits to the next level. Now, the next step is implement what you learn. Do you have all these items? Are you familiar with all these items? To learn more, head on over to trainingforlocalsmallbusinessowners.com, where we will continue to provide tools and resources you need to take your business to the next level.